Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thanks for having me.
So we had it's kind of a big week, although not a lot is really, I've not seen a lot of movement in markets necessarily, but we had the presidential debate last night, which I guess we could talk about briefly. And then obviously the big economic news is we have the CPI numbers for last month published today. What did they show?
Yeah, they showed a relatively strong rebound in owner's equivalent rent and in shelter, which drove the core CPI reading to come in at 0.28 versus expectations of 0.2%. And so, the market really latched onto that in terms of deciding whether or not 25 basis point cut is more likely than a 50 basis point cut. So we saw that meeting reprice much closer to 25 basis points today as a function of this beat in core CPI. And high level, I think what folks have been concerned with on the inflation side has been the past strength in services CPI, which we had seen cooling. And so the fact that you had this rebound in shelter today, kind of made folks pause a little bit. But in terms of what's driving the overall response function of the Fed, I would say that inflation data is probably the least important part of their mandate at the moment. Mm-hmm. They're most focused on the employment side of things.
Yeah, and where do we stand on that at the moment? Whatever the latest data is. I mean, was it ADP like 2 weeks ago or something like that? Or
we got non-farm payrolls last week.
Yeah,
and that showed a modest decline in the pace of job growth, which was super important.
Yeah,
and you're starting to see basically below like kind of neutral rate payroll growth, and so it's starting to get concerning. And you've also seen a meaningful uptick in the unemployment rate as well. And so, and then you had the revisions, the 850,000 revisions from the prior month. And then in addition, the last non-farm payrolls, you revised lower the prior months, by like 20, 30,000 jobs. And also, if you look a little bit deeper, job openings saw a huge decline, the other week. The past job opening numbers were also revised lower. And then, digging a bit deeper in terms of like where you're seeing strength and weakness in the labor market, the strength has been in things like government sector jobs, and the weakness has been in like private sector jobs. And
not great.
And so in addition, you've had, and if you look at the job opening data, it's like job openings for like, white collar stuff and like coding jobs, like they've
I saw tech jobs falling off. Yeah.
And then if you really kind of want to analyze like some of the initial jobless claim figures, I think folks are coming around to kind of a more nuanced appreciation of these figures, from the sense that like now when you lose your job, like you've got a lot more options in the gig economy in terms of like what you can do, right? So you get unemployed, and all of a sudden, you can probably pick up 20 hours at like $15 to $20 an hour.
DoorDash or
Uber, whatever it may be.
Yeah.
And so you see less people filing for unemployment benefits,
but they're not
and stuff.
Real strong, longer-term jobs.
And so, if you look at other metrics like the underemployment rate, the U6 employment rate, those things are I think that's almost at like 8% now.
Yeah.
And so ultimately, in terms of what the market's going to be looking for on a go-forward basis, they're going to want to know what the Fed is thinking on a go-forward with respect to the job stuff.
Yeah.
And they're going to find out in the summary of economic projections that are going to be released during the September FOMC.
Yeah.
And so in theory, what you should see is their forecast for unemployment for the balance of 2024 and 2025 and 2026 to start creeping higher. And also, you will get, insight into where they think the rate path is going to be on go forward in terms of neutral rate and dots.
So it's the dual mandate. We've now, the inflation is, it's still present. It's still above target, but it's cooled pretty substantially over the year. But now unemployment is the question. The other part of their mandate to seek what full maximum employment, whatever the term is, and that's But we're going to get a rate cut next week, though, from the FOMC, though. That's right? That's what
That's
everyone
right, but
predicts?
it's not like necessarily a good thing, which like a lot of folks in crypto and in broader markets, they're like, Fed's cutting, we can buy risk assets again. But you really have to focus on why they're cutting.
Yeah.
Right? They're cutting because the economy is losing momentum.
Right, which is a bigger negative sign for asset values.
Absolutely. Right. You're talking about like S&P earnings growth that's expected to be, let's say 9% next year. And for the big tech companies, expected to be like closer to 14.
Yep.
Right. And in 2025, you're also expecting, a decent amount of growth in earnings. Right. And so there's a lot of optimism baked into the equity markets. Right. And then on top of that, like typically when you see unemployment rise, you typically get a bigger rise, known as the SOM rule. I don't know how to say it properly. Yeah. But all of the things that we look at in terms of being good indicators of what's going to happen on a go forward with respect to employment are flashing warning signs.
Yeah.
And so, again, you walk through the example. Guy goes from high-paying job to a lower-paying job or no job. He eats out less. There's a multiplier effect. Spends less.
Buys fewer things.
Fewer things. Also becomes more indebted because credit card balances are through the roof.
They are right now,
interest rates are really high.
Yeah.
And so it becomes a lot more difficult to service that. And you fall into this debt trap. If asset prices start declining, that'll lead to further asset price depreciation. And so there's a lot of bad things that can be precipitated by downturn.
Right.
And so, when folks are like, oh, it's great that the Fed's cutting, that should be good for risk. Yeah, but not really.
Yeah.
And then the other thing to think about is that the historical kind of analogy with respect to rate cuts, is a little bit different now from the sense that, the Magnificent Seven companies and a ton of companies in the U.S. used to hold or currently hold tons of cash balances, right? Versus historically, companies used to not have that much cash on their balance sheets, right? Because they had more productive uses of it, et cetera, and they hadn't gotten so big. But now, a lot of the Magnificent Seven tech companies, et cetera, they carry huge cash balances. And so when interest rates were rising, their net interest income was actually going up a lot. So in theory, on the way down, right, their net interest income should also be going down. And so, the classic like rate cuts are coming, so equity should do well. Like it doesn't necessarily hold. It's a lot more nuanced than that.
Yeah.
Especially when you've got so much baked in. Like look at a 5-year chart of the NASDAQ or the S&P or a 10-year chart. Like risk markets are at the dead highs.
Yeah.
And so, I think we're at the point in the cycle where, one should be cautious about risk assets and should really look into why we're engaging in a cutting path and why the bond market is telling you that the Fed is going to be very aggressive over the next 9 months.
Interesting. Well, we do have a monetary instrument that is not does not have a team of people meeting every month to adjust its inflation rate. You have to wonder, is the sort of, I guess what I'm pivoting here to obviously is the Bitcoin. Is it when, if ever, is it now? It probably isn't yet now. Does Bitcoin transition to being something that is more of a fundamental asset and not a risk asset? I mean, that's sort of the question, right? For long-term Bitcoin investors, presumably it's not always a risk asset, right? I mean, risk assets have management execution risk. They have things like interest rate risk. They have all these risks.
Yeah.
That's what makes them risky.
I don't know if you'll ever get to a point where Bitcoin isn't a risk asset. It will always
gold's not a risk asset, right?
It has some elements of that to it, in terms of just looking at its performance, right? At the end of the day, it's an asset people own, and people get impacted by how they feel.
It's true.
And in terms of like how you run a portfolio, right? Like even when in the depths of the financial crisis, like gold is a great own, but it still went down in 2008 because everything goes to correlation 1 and risk-off events.
That's right.
And so you're never going to really avoid that. But I do think that it just will set higher and higher floors with respect to like when risk sells off, et cetera. I do think that, in theory, like that folks aren't going to sell their Bitcoin at certain levels.
Right.
Right. And so, ultimately, I do think you're in the path of setting higher and higher floors in the price, and ultimately, you should start to go higher. And truly, when I do think, the Bitcoin will have its moment again from a macro standpoint
Yeah.
is when the money printing actually starts.
When it really starts, not
Which
just some
is
rate cuts, but
not some rate cuts, but it's like we're going back to balance sheet expansion.
Yep.
We're going to buy a ton of the debt that the U.S. government issues by printing money.
right.
And so that's when you really, are going to get that, like, what is money if we could just print it out of thin air
Exactly.
and buy stuff. And so, when the market gets that sense that you're close to that kind of event, is kind of when I think Bitcoin will have
That's the
its
macro
moment.
Bitcoin moment. Beimnet Abebe from Galaxy Trading, as always, my friend. Thank you.